Hello and welcome to our weekly look ahead in the markets. And just to recap, we've obviously seen a big blowout in global bond markets, a very steep rout. In fact, Bank of America on Friday in the Flow Show calling it the biggest bear market in bonds of all time. That's maybe over egging the pudding a little bit, but it has been a sharp deterioration in bond markets. We saw the US 10-year yield, for example, hitting a fresh 16-year high last week. The 30-year long bond up above 5%. Again, also most in over 16 years. Japanese yields also on the march, despite the Bank of Japan ferociously trying to defend their yield curve control targets. And then UK gilt yields are moving up as well. So the 30-year gilt yield last week hit its highest since 1998. So any talk about the mini budget and the trustonomics effect, well, that's sort of out the window now as we see bond markets really rampaging and a lot of selling taking place, a lot of destruction of capital taking place. I think this is going to have long-term implications for risk assets as well, the amount of capital that's being destroyed by this bond sell-off. So that's the sort of backdrop that we're coming into this week. Now, we obviously had the non-farm payrolls last week, a lot of jobs data last week, in fact, and JOLTS job openings was the catalyst for that bond market sell-off, really accelerated the move. We've seen bond yields be moving higher for some time now, but that Tuesday report really lit a fire in the bond market, and we saw sharp moves in foreign exchange as well. The dollar index touching 107, and the yen we saw it dip below 150, and then a very sharp reversal. Not sure if it was intervention or not by the Bank of Japan. It's a psychologically important level. We'd sort of been primed to believe that the Bank of Japan would be intervening at that kind of level, and that might have just been the sensitivity around that level might have been the trigger for some traders to get in on that, and that maybe was what caused the move. But money market data out on Thursday suggested it wasn't Bank of Japan intervention. So lots happening around central banks and bond yields as ever. And it does seem very much that the bond market is dictating what's happening right now across the piece. And last week also saw some big moves in oil, big reversal off those highs, those one-year highs that we saw just 3 weeks ago. We're now tracking significantly lower for oil. So coming up this week, our eyes on the US inflation report. That's the CPI number. It was up 0.6% headline, 0.3% core last time out. It's a bit of a pickup in inflation, but still that core level coming down to 3.7% annually. That's starting to look a lot more appealing to the Fed. A sort of 3 handle on core CPI is something that they'll be perfectly happy about. And also we're looking at the earnings season really getting into gear with the big banks up on Friday. JP Morgan, Citigroup, Wells Fargo, BlackRock, United Health also in action. PepsiCo and Delta are coming up ahead of them, but really looking at these key banks, JP Morgan, Citi, Wells, that's going to be the key really to see just what sort of read Wall Street's got on this and what the sort of interest rate picture is looking like. What sort of, duration risk is sitting on the balance sheets of some of these banks. The Bank of America is the one with the most, but also looking at the likes of Citi. Now it's trying to go through a turnaround. Jane Fraser, the CEO there, trying to overhaul the bank, but the share price has really struggled. It's really underperformed peers and continues to trade its weakest since 2020. So Citi is a lot of focus will be on that stock, and I think for the rest of the market, for the wider market, we'll be looking at JP Morgan, Wells as well to see just sort of what sort of story they're telling about the US economy and about interest rate risks, both for them and for the wider economy. So that's what's coming up in the week ahead. Thanks for watching.